If you're a retail investor keeping a close eye on the Malaysian market, you've almost certainly seen the headlines blowing up about Solarvest's latest full-year FY 2026 results. Well, in today's explainer, we're doing a fast-paced, highly structured, and totally objective dive right into their latest quarter and full-year numbers. We're going to cut straight through the noise and focus squarely on the metrics that actually matter to us: earnings, margins, the order book, cash flow, and what the future outlook truly holds. Let's get into it.
Let's kick things right off the bat with an absolutely massive number: 926 million ringgit. I want you to take a second and just ask yourself, what do you think this represents in the context of Solarvest's recent fourth quarter? Is it their full-year revenue, maybe the valuation of a brand new mega contract?
Get this, that $926 million isn't a full-year revenue figure at all. No way. It is the order book addition for Q4 alone. Think about that. At the end of FY 25, their order book was sitting at $1.54 billion in confirmed unbilled future work. Just 1 year later, by the end of FY 26, it absolutely skyrocketed to $2.47 billion. To put that into perspective, that single quarterly addition of $926 million is literally larger than the entire annual revenue of most companies listed on Bursa Malaysia. This massive influx of future work forms the absolute heartbeat of the Solarvest story. Pretty much everything we're about to discuss flows directly from this single metric.
So, moving to Section 1, FY 2026 earnings breakdown, let's dissect the scorecard. Okay, let's dive into this. A massive order book is only as good as a company's actual ability to execute on it and, bill for it. For the full year, Solarvest's revenue jumped from $537 million in FY 25 to $757 million in FY 26. That is a massive 41% year-over-year growth. So what exactly is driving this surge? Well, the financial reports point directly to utility-scale projects. We're seeing much stronger contributions from the commencement of multiple large-scale Solar 5 or LSS5 projects, and they're working right alongside the continued execution of the corporate green power program during the quarter. Basically, they're scaling up significantly and really executing on those large national mandates.
But, as we all know, top-line growth means absolutely nothing if it doesn't successfully drop to the bottom line. And here we see the profit after tax, or PAT, hitting $82.08 million. That's a 53.9% increase year-over-year. Notice something really important here. Profit actually outpaced revenue growth for the full year. It grew almost 54% compared to revenue's 41%. This cements a fundamentally strong performance and clearly demonstrates operating leverage. As the volume of their projects gets bigger, they're actually keeping a larger percentage of the money they make.
Which brings us to Section 2, the margin and tax warning. It's time to peel back the onion a bit.
As retail investors, we can't just take a victory lap on those shiny top-line numbers without digging a bit deeper. Here is a critical, analytical question for you to ponder based on the Q4 data. In the fourth quarter alone, profit before tax grew by a very impressive 46.7% year-over-year, hitting around $41 million. But Q4 profit after tax only grew by 23.1%, landing at $24.8 million. So why is there such a massive gap between pre-tax and after-tax profit growth in this specific quarter?
The answer lies in an effective tax rate anomaly. During Q4, Solarvest recorded a 39.4% effective tax rate, which is drastically higher than Malaysia's legal statutory rate of 24%. Management attributes this to an underprovision of prior period taxes and deferred tax adjustments. Now look, it's super easy to just dismiss this as a one-off accounting event. But smart retail investors don't accept one-off at face value, without verification. You need to track this specific effective tax rate in every single quarterly report as we move through FY 2027. If it normalizes back down to that 24 to 28% range, then the thesis holds. But if it stays elevated, that means margins are being structurally squeezed, and you're going to need to adjust your valuation models accordingly.
Moving right along to Section 3, Cash Flow U-Turn, from burn to generation.
Remember, profit is just an accounting metric, but cash is reality. And in FY 2026, we witnessed perhaps the most dramatic turnaround in Solarvest's entire set of financial statements. In FY 25, Solarvest consumed $87.5 million of cash from operations. They were a cash-hungry business, heavily pouring money into scaling operations and getting projects off the ground. But in FY 26, they generated $90.6 million in net cash from operations.
And this brilliantly illustrates how, in just a single year, the business fundamentally flipped from burning cash to generating it. That represents a staggering positive swing of nearly $178 million in net cash generated from operating activities. So why did this happen? Well, it wasn't just luck. It happened because Solarvest hit major construction milestones simultaneously in Q4. That triggered massive revenue recognition and, crucially, cash collection at the exact same time. It proves that their years of building a robust project pipeline are finally bearing fruit and translating into cold, hard cash on the balance sheet.
Finally, Section 4, Future Outlook and Scenarios. Let's talk structural transformation.
Pivoting from historical numbers to the future. Remember that massive $2.47 billion backlog we discussed at the very start? Management has confirmed that this order book is going to be progressively recognized across the financial years ending March 2027 and 2028. This effectively creates a 3-year earnings floor. Assuming a steady burn rate, Solarvest essentially knows exactly where a huge chunk of their revenue is coming from for the next 2 to 3 years. In the Malaysian construction and engineering sector, having that kind of long-term revenue visibility is an absolute rarity.
But you know, the story actually goes much deeper than just fulfilling engineering and construction contracts. Under their Powervest program, they've secured a cumulative capacity of 133 megawatt peak from multiple corporate power purchase agreements. Now, this is expected to contribute $53 million in annual recurring revenue upon full completion within the next 12 to 18 months. And this right here highlights the core transformation narrative of our explainer today. Solarvest is deliberately moving away from being just a cyclical contractor relying on one-off projects to actually owning utility assets that generate steady, predictable, recurring income for decades.
So, to wrap up our analysis, let's equip you with an objective, balanced framework for your own due diligence. Based on the data, here are 3 forward scenarios. The bull case. Flawless execution on that massive order book pushes revenue past $1.2 billion by FY 2028, aided by significant wins in upcoming LSS6 and CRESS initiatives, with recurring revenue from Powervest hitting its targets. The base case. Revenue sits comfortably between $900 million and $1 billion in FY 2027, with net margins holding steady at a very healthy 26 to 28%. And finally, the bear case. Module price increases compress those margins down to 23 to 25%. Administrative delays push revenue recognition further out into FY 2028, and elevated borrowings increase financing costs, stalling EPS growth.
Which brings us to our final thought for today. The numbers we've looked at show a company at a major inflection point. Solarvest is no longer just a company that builds solar farms for other people. It's right in the middle of a multi-year structural shift, transforming into a fully fledged power company with its own recurring income assets. The policy environment is highly supportive, and their execution track record is currently strong. But, as we saw with the tax rates and those bear case risks, you have to stay vigilant. So my question to you is, do you fully understand this structural shift, and are you ready for how it might change the character of this business over the coming years? Thank you so much for joining me on this explainer. Keep digging into those financial reports, verify the numbers for yourself, and as always, stay curious.